Well, we had a nice bounce back day after a one-day pullback there yesterday. In fact, the Russell 2000 hit all-time highs here today, so all of a sudden small caps are starting to look pretty nice. We also had some nice movements out of the NASDAQ and also really the S&P 500. So, of course, our postures remain mostly bullish across the board. Today, I'm going to look at kind of an emerging sector that is traditionally doing a little bit better towards the end of an economic cycle and kind of a forgotten about industry group within that sector. So with that, let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It is May 16th, 2018. For those of you that are new, welcome aboard. We're happy to have you here. Remember, you can subscribe to our YouTube channel by clicking that red subscribe button. You're also welcome to give us a thumbs up. You can leave some comments for us. And then if you scroll down a little bit further, you can also see our description area. Allows you to sign up for our email distribution list. That'll allow you to get the emails whenever we send these out every night, and then also let you know which stocks within the S&P 500 are giving you overbought and oversold cluster signals. Now, in addition to YouTube, we're also heavy users of Twitter. In fact, you guys have been doing a great job for me this week on the Twitter likes. Keep it up. Remember, I'm your hired gun this week. As long as I'm getting 100 Twitter likes, I will plan on doing the video the next day. So basically, tomorrow, which is Thursday, I'll look at the market close. If I got 100 likes on the Twitter tweet that contains this particular video, then I'll go ahead and do the video again for Thursday, and so on and so forth. So you guys did a great job. Last I checked from last night's video is like 188 likes. So fantastic across the board. Keep it up. Thank you so much. In addition to Twitter, you can also kind of associate with David and I on Facebook. We do have a group there. You can see the web address on the screen there in front of you. All right, let's go ahead and jump into a little bit of analysis now on the S&P 500. You can see here that we were up 0.31% here today. That was 8 points on the S&P 500. And you can also see that we had kind of what's known as a cajole to close above the high of the low day. Now, it was real close. So, you can always double check the numbers here by looking at the highs and the lows over here and comparing it to the low candle versus the candle here today. But it does look like we barely got up and over that high from yesterday. However, it wasn't quite as clean of a breakthrough as maybe some bulls would want. Obviously, we do have that long upper shadow right there, and so it does remind us that the bears didn't just give up here. They did push that market back down a little bit by the end of the day. But all in all, considering we had just gone up 8 days in a row on the Dow Jones Industrial Average before yesterday, for us to kind of stabilize just one day after a pullback is actually quite significant and shows the strength of the bulls in this market right now. You can see that, of course, we still have a bullish posture using that intermediate term line. Now, remember, you can develop your postures with this market forecast tool that you see down below here from a variety of perspectives. We generally default to that green line down there, which is our intermediate term line, so our posture for the next, let's say, 2 to 3 months. But if you're more of a swing trader, you might be looking at the blue line. That's giving you a little bit more of a hiccup there, again, because we didn't close near the highs of the session here today. That red line is kind of more for the day trading community out there. The really long-term folks are going to look at that dotted orange line plotted on the chart right there. That's our market sentiment line. And right now you will notice that the market sentiment line is at 40.89 and falling as of this moment in time. So that would be slightly bearish, although as you kind of eyeball this dotted line on the graph here, it does look mostly sideways. So I don't think it's a dramatic move, whether it's bullish or bearish on the posture right now. But of course, with the intermediate term line, that green line, that is more emphatic. It's clearly in the upper reversal zone and has been really kind of solidifying that bullish posture for a number of days. Remember, this chart right here will turn green and red whenever we do get those bullish and bearish postures using that intermediate term line. So really, we've had a bullish posture on the S&P 500 since May 4th. And so we're now, 12 calendar days since then. So things are shaping up pretty decently there. Let's go ahead and take a look at our next grid now. This will be a 4 grid here, and I want to show you the Russell 2000. There it is, down in our lower right. notice that we do have a new high today. Now, one feature that I haven't been able to highlight since I rebuilt a lot of my charts here along with some help is that we have this label that will show up whenever we're getting a new high. So notice right here, there's kind of this lighter green label on the chart that says yearly high today. That also works if we ever get a yearly low. Of course, we're a long ways away from that. So anyway, since we've been kind of chopping and slopping sideways for the last several months, we haven't had an opportunity to highlight that particular label. But finally, we get an opportunity to do that here with the Russell 2000. So nice clean breakout there with the small caps. We really only had a 2-day pullback right there. We never did lose our bullish posture, and it looks like they're exerting themselves as kind of a leadership of this market right now. Can see down below here in the lower left, the NASDAQ also had a hold and continues to have bullish signs there, although not quite at all-time highs, still stabilizing above that rising moving average right there. As far as who our laggard was today, it was the Dow Jones Industrial Average. We were only up 0.23% on the Dow today, so it does look like investors are favoring small caps over the mega caps at this current time. Let's go ahead and do a little bit more analysis. In fact, now that I'm kind of having that conversation, let's go and do a ratio chart 12 grid. Now for this, I do have to kill that camera feed so that way you guys can see all of these various charts here. But the chart that I wanted to point out here was down here in the lower right. Let me double click on that in this kind of blank area that you see right here for those of you that are following along at home that have gone through my charting tutorial. If you're a Market Scholars Premium subscriber, remember you can always follow along with what chart I'm in by looking at the pink label in the upper left up there. So this is chart 4I. But I'm going to go ahead and double click in this blank area right here, and you'll see that not only did small caps hit a new high by themselves, but on a ratio basis versus the mega caps, they also hit a new high here. So when we see a chart like this that starts in the lower left and ends in the upper right, and this is a ratio chart, what this is telling you, according to this label right here, is that small caps are vastly outperforming mega caps. And it's been really a consistent theme as well. It hasn't just come out of the blue. So that one's been working pretty nicely. Of course, another one that's been working really nicely right here, commodities to bonds. Now, speaking of which, I actually am teaching my strategy lab class here tonight. So for those of you that are premium subscribers to Market Scholars, I'd invite you to join me in that class. I am going to be talking about commodities and also foreign countries here tonight as part of 2 of the 50 strategies that I'm tracking in paper money for that particular class. So I'd invite you to join me there. Of course, that is at 6 p.m. Eastern time if you want to attend live. Otherwise, the recording will be available for you as well. But anyway, commodities really crushing it here recently, especially in comparison to fixed income. Many of us are aware that interest rates have continued to go up, so it makes complete sense that bonds are struggling, but that doesn't necessarily guarantee that commodities are doing well. But according to what we're seeing here, clearly commodities are the place to be, at least in comparison to some fixed income instruments out there. You can see from a VIX to VXV ratio perspective up here, we did fall a little bit here today, 5.92%. But like I was mentioning yesterday, we're kind of in no man's land right now. We're not at any sort of extreme levels, so not a whole lot to discuss from that perspective. Generally speaking, I don't see a whole lot of other, great trends. I would say this, the discretionary to staples. This is kind of an interesting one too, and it's usually kind of an acknowledgement that investors are willing to take risk. Remember, discretionary stocks are representing the products that you might desire or want. Staples would represent the products that you need. And so when we're in an environment where consumers are spending money on things that they want over things that they need, generally speaking, you'll see that the stocks themselves will follow suit as well. Of course, last night we talked about one of those discretionary stocks, Adidas. And unfortunately, Adidas popped higher here today, so we did not get filled on that trade application example from yesterday. That always kind of irks me because, of course, you're right on your analysis, but you don't get the victory, so to speak. So one of the things that you guys might be aware of that David and I have mentioned in the past is that we are thinking about potentially, for those of you that are premium subscribers to Market Scholars, we're thinking about doing kind of a little mini market outlook session during the trading day, that would help us get our trades filled and also manage our previous trades for those of you that are premium subscribers to Market Scholars. And then for those of you that are not premium subscribers, if you just want to continue to watch our free videos here on YouTube, we would still have our general market analysis after that. So anyway, we're still kind of working out some of the kinks on how we would get that done from a scheduling perspective. But in a case like I had last night with Adidas, you know, if we, let me do this real quick, pop on over here to Adidas. I'll show you what I'm referring to in case you didn't track this particular one today. But you'll notice Adidas was up 2.6% today. And of course, we wanted to buy it at yesterday's closing price due to this bullish cluster, or I should say oversold cluster here. And unfortunately, just didn't get that opportunity because it gapped higher on us here this morning. So if we are placing these trades at the end of the trading day, right before the market closes, we can actually get filled on some of these ideas that we might not have otherwise. So stay tuned on that. David and I will keep you kind of posted from that perspective. Let's talk about a few other charts here while we're at it. Let's go ahead and take a peek at, let's do some asset class comparison. So right here, this is going to be kind of our line comparison chart right here. And it, by default, starts off with a one-year daily kind of view here. Again, for those of you that are following along at home, adjusting your own charts, this is chart 4L. And you can see that there's one asset class that is far and away the best performer in the last year, and that's oil. Oil is up 43% over the last year. In second place is the small caps that I mentioned before, which by themselves are doing very well, hitting all-time highs here today, but only a 16% year-over-year return. That pales in comparison to what we saw there out of USO. You know, interestingly enough, on the downside, you see it's DBA. And remember, if you don't know the ticker symbols off the top of your head, DBA may not be the most recognizable ticker symbol for some of you. So remember, I've also color-coded the labels up here to help you recognize what we're looking at. And so that kind of turquoise color down there that says DBA is ag commodities or agriculture commodities. So kind of interesting environment that we're in right now where we've got oil leading the way higher over the last year, and we've got agriculture commodities actually one of the worst performers from an asset class perspective. And again, I'll be discussing both of those here tonight when we get into our strategy lab conversation for you premium subscribers. If we were to look at maybe a shorter time period here than just 1 year to see what's been working a little bit more recently, let's go to a 3-month daily candle here. And you can see it's still oil that's leading the way. Now, over the last 3 months, oil is up the exact same amount that IWM is up over the last year. That, again, goes to show you how aggressive traders have been in pushing that price of oil higher and higher. So oil's up 16.8% just in 3 months alone. Over the last 3 months, you actually do find that the US dollar, UUP, is outperforming IWM, which is hitting an all-time high. Now, that is very peculiar. You generally do not see a basket of foreign currencies versus a dollar move as dramatically as a basket of small cap equity securities. Typically, you don't see big movements out of currencies unless, of course, there's some geopolitical news or what have you. So it just goes to show you that the dollar is very, very strong right now, and is a reminder of why some of those other commodities are struggling, even though oil is continuing to buck that trend. Let's take a look at another chart here. Let's just briefly look at the VIX, because I know some of you like me to look at that VIX. And so here's the VIX down below. Actually, we have a better chart than this. Let me do this. Let me go over here to, where did I put it? It's this one right here, 4N, as in Nancy. And you can see the VIX was down about 7% today. Not a big deal there. Again, anytime the markets are moving one direction, you should assume that the VIX will move in the opposite direction. So what that's telling us is that if we had an opportunity to sell some premium yesterday, that might have been a little bit better than if we had an opportunity to sell premium at the end of today. Premium prices have decreased in value based off of that deflated VIX that we're seeing right there. Let's do another analysis here. I want to find the sector comparison, maybe this one right here. There we go. And you can see over the last year, it's technology that's leading the way higher, up about 24%. On the downside, we do have telecom that's really struggling, down 16%, and then staples, and then utilities, and then REITs. And all those probably lumped together in your guys' minds because they are all interest rate sensitive. They are all generally known as higher dividend paying areas of the market. And of course, when interest rates go up, those particular areas of the market do tend to struggle to a degree. Over the last 3 months, we see it's energy that has taken the lead. So over the last year, it's technology. But in just the last 3 months, we've seen that emergence of energy stocks that have really started to turn on the accelerator there. On the downside are those consumer staples that have really been struggling to find a bottom here. Although over the last week or so, maybe they're attempting to put in a bottom. So we'll keep our eye on that as well. All right, let's go ahead and talk about our trade application example for the day. One thing that I did want to point out, so let me go over here to our US sectors 12 grid real briefly. If you look at this chart right here, this is the materials names. Notice that materials were up 1.19% today. Notice that the background color of their chart is green, telling us that we do have a bullish posture using that intermediate term line on the market forecast indicator. We also have a green moving average here over the last couple of weeks because price is now above a rising moving average. Notice that back here, price was always below a falling moving average, or occasionally when you have these kind of yellow blotches here within the moving average itself, it means price was above a falling moving average at the time. But really, it was only starting here on 5/7, it looks like, so May 7th, that we had price consistently above a rising moving average. That's generally perceived positively. We also have a higher low that was established here at the beginning of May. So remember, trend traders are looking to stay in trends as long as the trends exist, but trends will eventually reverse. And one of the ways that you can identify a reversing downtrend is to start looking for things like higher lows. And that's what we did have, because we had this low over here in April. We had a higher low here in May. Now the next piece of that puzzle is to get a higher high, and we're not quite there yet. We did put in a high over here at, let's see, it was on April 18th. And so we're not quite up and over that yet, but if we get a couple more days like today where we're up 1.19%, we may very well get there. Now, as mentioned many times in these presentations in the past, what you typically find in the late cycle is that the two strongest sectors are generally oil and materials. And we have certainly seen the strength out of oil. There's no questioning that. But we haven't really seen the consistent strength out of materials. So tonight, what I thought we would do is kind of focus on maybe a trade where we could get into some of those materials-related names. Now, before I do that, I also had another comment of somebody that wanted me to review the best stocks within those sectors. So since materials were our best sector today, and again, we can confirm that by looking at this over here, materials were up 1.19%. Discretionary was up 0.8%. Some of you might have seen, by the way, a lot of those retailers were doing really well today. In fact, let me do this. I'm going to go over here to Twitter real quick and show you as a reminder that I do the, oh, and by the way, thank you for you 189 people that clicked the word like. That's the reason I am giving you my analysis right now, because we were up and over 100. So again, don't forget to do that yet again today. We were down quite a bit from Monday's number of 230, but still hard to complain with 189. That's a fantastic job. I appreciate you guys. But the point I was going to make over here on Twitter, the 9 at 9 right here. Remember, I do this every morning at 9 a.m. Eastern time to give you guys a heads up of what stocks are most likely to be affecting the market that day, because many of these companies are moving pre-market for a variety of reasons. You know, it can be earnings or other news-related events. Well, you'll notice that there is definitely a theme going on the left-hand side, which of course represents the up. You can kind of see that in my alarm clock here. It says up right there, and these ones over here are down. So Macy's was a leading stock here today. Dillard's, GameStop, Nordstrom, Kohl's, Target, and Gap. If I kind of get my mouse out of the way, you can see all of those. So out of those 9 stocks that were up pre-market, basically all of them except for 2, so 7 out of 9 were retailers. And so retailers were really kind of the bells of the ball here, or the bells of the the ball here today. So keep your eye on those as well. On the downside today, we did have those two interest rate sensitive areas that struggled. So we had XLRE, which is real estate, and then also XLU, both in the red here today. Again, kind of struggling due to the coming of terms with those higher interest rates as the 10-year continues to consistently now be above 3% yields. If we wanted to go in and look at some of the biggest performers within that materials space, for those of you that like that sort of analysis, let me come in here and go ahead and show you from a materials perspective some of the bigger performers out there. And you can see that we did have U.S. Steel that was up 4.6%. We had Freeport-McMoRan that was up 4.2%. Packaging Corp of America up 3.6%, and then Nucor, which is of course the only steel company that's on the Dividend Aristocrat list, for those of you that like those dividend stocks, that was up 3% here today as well. So some nice movers out of especially those steel related names out there. Keep your eye on those as well. But for today's trade application, what I wanted to do is actually focus on an industry group that has really been largely left for dead. The destruction in the coal space has been really one for the ages. Kind of interesting to see how many of the coal stocks that existed 10 years ago eventually went bankrupt. So what is left is kind of a smattering of companies that were lucky enough to survive, and then also a handful of other companies that went bankrupt and then came back and did another IPO or a secondary offering and kind of came back to the public markets. But anyway, KOL is one of the few kind of more diversified ways to look at coal. Now I got to be careful when I say that because it's not really diversified. It does have a number of names in it, and that's why it's an ETF, but it's still concentrated on one unique theme, which is coal. Well, of course, coal is part of the materials space itself, and you will notice here that coal, all of a sudden, this particular ticker symbol, KOL, is up pretty big here today. We were up 2.5% on that entire ETF. Well, not only were we up, but we have a strong bullish posture right now. We know that because that background color right there is a dark green color as opposed to this light green color. So that means that this green line down below here on the market forecast is above 50, meaning a more strong bullish posture. And then we also, of course, have that moving average line that has just recently turned back to green here, representing the fact that we have price above a rising moving average yet again. Now, in addition to all of that, we have kind of a little bit of almost a reversal pattern that's taking place. You can almost see a left shoulder over here, kind of in this area that I'm circling with my mouse. And then, of course, we have this head right down here. And then we might have had just a tiny little bit of a shoulder over here. It's not textbook by any means, but the main idea is this was an instrument that was continually in a process of putting in lower lows. That stopped. We put in a low right here, it went up, it pulled back, and it did not breach that prior low. And now what it's done is it's gone up and actually breached that prior high. That's generally a sign of strength. So remember that the materials were the best performing sector today. Coal was likely one of the best performing industry groups within that sector, up 2.5% today. So what we're going to do is we're going to do a one cancels one order. So this will be a straight up kind of stock trade. This one doesn't have a lot of options liquidity out there. And we'll just do 100 shares and we'll just kind of dabble with this and see how we do with it. But where we stand right now is basically in the middle of the range over the last 3 months. You can see this thing had a high of 1812 over here and it had a low of 1511 right back over here. Where we stand right now is 16.6. And so if I got my calculator out, that should be right around $1.50 if I'm doing my math right. So 16.6 minus $1.50 is 15.1, which means that if we put our stop loss down there at 15.1, it would have to breach the lowest price that it put in back here when it went down to 15.11. So in other words, if this breakout fails, it would have to go down to new 3-month lows before we were stopped out of this trade. On the other hand, if this is a sign of things to come and this breakout leads to even more interest from buyers, this thing very well may be reaching towards its highs over the last 3 months. And so let me clear the calculator here, put 16.6 plus $1.50. And there you'll notice 18.1, just a hair below that high of 1812. So kind of a nice way to kind of hug the top or the high and the low of the last 3 months with a trade idea here in paper money. So let's go ahead and place that trade. I'm going to go ahead and right click on the chart. I'm going to go to buy custom, and I'm going to use with OCO bracket. I'm going to click on that. I'm going to leave this just as 100 over here. You can of course adjust and position size however you want with your own account, but I am going to change the limit price. This one has a kind of a wacky number here after hours of 1823. Of course, we don't want to get filled there if this thing closed at 1660 today. So I'm going to put in my order at 1660, hoping that we get filled tomorrow morning at the same price where it closed here today. And I'm going to put in the second line down below here, the first one that is in pink, where it has a number representing in there. I'm going to go ahead and put in $18.10. $18.10. And I'm going to put in an order for a good till cancel order rather than a day. So this will be 18.10 limit good till cancel. And then on the next line it says stop. I also want to change that line to good till cancel. And then the final line will be at what price do you want to be stopped out, or what price do you think you'll be stopped out, and that'll be $15.10. Again, this is $1.50 of possibility to the upside, $1.50 of possibility to the downside. In other words, a 1-for-1 risk reward ratio. So with that, let's go ahead and click confirm and send, review this one last time, and we'll send that one in and see how we do. All right, with that, I want to thank you for joining me here today. Once again, I appreciate your guys' likes there on Twitter. If you want me to come back for some more analysis tomorrow, don't forget to go over and click like. Remember, there's 4 different ways you can like these videos on Twitter. I showed you 4 different ways in that Monday video for those of you that need a reminder on that. As long as I have 100 likes, tomorrow at market close, I'll plan on doing this market outlook video again for you at that time. If I have 99 likes at market close, then it won't be happening, and then I'll wait until Friday to see if we can get up and over 100. So I'll leave that in your hands. As I mentioned yesterday, I'm your hired gun this week. As long as you guys have the commitment and the motivation to actually click a button and click the word like, then I'm at your beck and call. So with that, have yourself a great rest of the night. I'll see some of you here in just a little bit in my strategy lab class. For the rest of you, maybe we'll see you tomorrow. Maybe we'll see you on Friday. Have a great night, everybody. Take care. Bye-bye.